I have to say my name, that's fine.
All right, so thanks for being here. So it's an honor for me to introduce Ricardo Reis, Philip Professor at London School of Economics and a prominent macroeconomist. Actually has been an influential, very influential economist in my career. So before LSE, Ricardo was a professor at Columbia, and he started his career at Princeton, as most of you know. And actually, if you look at his CV, I think there are something like 20 plus keynote speeches. So I realized that you are collecting more speeches than Messi is collecting golden balls. So it's pretty impressive. So in his early career, he started working on deviations of economic agents from full informational rational expectations. Okay, something that nowadays is very popular. Okay, but the thing is that Ricardo did it something like 15 years, 15 probably more than 15 years ago. And that has been very influential, because if you think about economic agents forming expectations, if you ever look at this data, so this data is very noisy, this data is all over the place, but somehow Ricardo found a way to putting this into a context of rational inattention and inattentive behavior by economic agents, and being able to explain the economic behavior of these individuals much time before that what we do nowadays. And that is where he has influenced many scholars, including myself. I think I've wrote at least 3 papers out of Ricardo's work. Okay, and more recently, Ricardo has come back to the issue of inflation, and how inflation and inflation expectations are related, and in particular how you can use data from financial markets and surveys about inflation expectations, and learn about how the inflation expectation is going to affect inflation, and how households relate to the inflation anchor, and how this feeds back into inflation itself. And this now leads me to today's talk. Okay, when you think about inflation, there is an outstanding debate on what causes inflation. Okay, so why are we seeing such a high inflation nowadays? And one suspect is central banks. Okay, so they've been printing too much money. Okay, so they've been issuing too much reserves. And this talk comes very timely. Okay, so the optimum quantity of bank reserves by Ricardo is going to teach us about the trade-off that central bankers face in setting up money supply, in particular reserves, and how these might interact with their inflation stabilization goals. Okay, so without further ado, let me leave the floor to Ricardo, and let me tell you that I have very high expectations about this talk. So thanks, Ricardo, for
thank you.
being here.
So thank you everyone for coming. It's a pleasure to be here. Sadly, it's a pleasure a little bit tempered, because just this morning I heard the news that one of our very dear colleagues, Philippe Martin, seems to have passed away in the last 48 hours. And so I'd like to acknowledge him here, especially because for those of you who knew Philippe, and I think many did, he was an extremely influential and much loved part of the economics European community. He was a great contributor to public goods, always a very joyous presence, always organizing conferences, always participating in events like this, and being extremely generous to many scholars in comments and in discussion of research ideas. And also, especially Philippe was one of the absolute very best in the profession at being able to write applied economics, in the sense of keeping up with the latest developments in theory and applying them to the questions that were at the point very relevant to policymakers, notably participating in the Council of Economic Advisors in France and others. So I'm not the right person to tell you about all the many ways in which Philippe was a wonderful person, but I do, given that this lecture is supposed to be about an applied, using economic theory to an applied policy question, I'd like to start by just honoring Philippe and dedicating it to him if you want. Insofar, it's going to be very much in the footsteps of Philippe's, I think, contributions. With that in mind, when Volcker asked me to give this keynote, I think a few months ago, I think it was 6 months ago, I think what he probably had in mind was that I would talk about inflation, and a little bit like Luigi said. I was at first hesitated a little bit because I thought 5-ish months ago that for the most part inflation is going to come down and it's going to be very much of a solved problem. I was very much on the optimistic side. But on the other hand, there was another big question that the ECB was facing, and a question for which economic theory, I think, could provide guidance. And that led me to spend a lot of time in the last few months actually preparing this lecture. This is complete original material. Like, maybe if you love it, maybe I'll write it up. If you hate it, it's the only time it'll be heard. Apparently it's being recorded. I'll probably try to get it unrecorded. But I've thought quite a bit about this in the last few months, which is to think about the other question that the ECB is facing right now. And the other question the ECB is facing right now is, what about its balance sheet? So pretty much all advanced economy central banks over the last 20 years went through a period of very large expansion. Balance sheets used to be small, and then with a crisis they grew, and then with quantitative easing they grew, and then with COVID they grew, and they grew and grew and grew to being what used to be 5-ish% of GDP to raising to almost 40% of GDP in the case of the ECB at its peak. And if I show the Bank of Japan, it would be even higher, and the Bank of England somewhere in between that blue and red. We started developing a lot of theory to understand what the size of those balance sheets would be. But now, in the last 12 months, this balance sheet, this is just a zoom, this ends in 2023, so here's a zoom of the last 24 months. These balance sheets are falling very, very rapidly. So we went from a one-way shop for about 20 years to now showing that balance sheets can also shrink. They don't just rise. They're not like public debt. Sometimes they fall, it seems. But that has led to an important question, especially for the ECB before the Fed, because it's shrinking much faster at the ECB than it is for the Fed, which is what is the optimal level at which it's stabilized? If a function is no longer increasing but seems to have a maximum, at some point you have to start asking what's the optimal point at which that function should be, at least as a function of time. And that is an extremely important question that at the ECB, because it's shrinking especially quickly, that has to do with how it grew and some of the problems where it grew, is a question that over the last 3 months, and I was asked, and I went to the ECB quite a few times for conferences over the last 3 months, because this is now an extremely urgent question. Understanding, do we stop the shrinkage? Where do we stabilize it or not? Now, this is a well-researched question. If we think about the central bank's liabilities as being money, money is a very fuzzy concept and one that's been very studied in many economic society meetings. Let me just call it all the liabilities of the central bank. Then the question ends up being, what is the optimal quantity of ECB money? Let me start right away with a parenthesis, which is, hold on, is money really a liability of the central bank? In the typical model that we would write, money is not a liability. What money is there's a central bank, it prints this thing called money, banknotes with the king on them or so on, and then gives them out. It collects some revenue if it charges for giving them out. It collects no revenue if a helicopter drops them, as in a famous analogy. Either way, money is a durable good that was distributed and for which a price was collected or not. It's not a liability in the same way that a car is not a liability of BMW. It just was sent out or sold. Indeed, in the classic Sidrowski representation of the central bank, there is no balance sheet. The central bank is just like a firm that prints, in this case produces, in this case prints, distributes its good, and goes away. However, in accounting terms, and the way in which central bank accounting works, that's not the way they account for it. Because of the central bank prints currency, instead of just giving it out, buys some assets with it and carries those assets tend to be bonds. What happens is that it keeps the durable good in check as if it was a liability. That means that you have a balance sheet where the size is the stock of this currency, counting as a liability. Note that whether we're in case 1, the one we write often in models, or in case 2, the one that works in terms of the accounting, the economics is really the same. It's just an accounting definition of whether you want to call this a liability or not. And therefore, we can apply, as in this extremely famous essay by Milton Friedman, ask what is the optimum quantity of money? What was Friedman's answer in this incredibly influential essay? So influential, it's one of those that you can't even measure citations because people just mention it without ever citing the essay. Friedman answered, well, the quantity of money is whatever amount of money ensures that the nominal interest rate is zero. And so the Friedman rule is often repeated as interest rates being zero. For a little bit of historical background, Friedman in 1953 was, I think, one of the first, or at least mentions to note that the opportunity cost of currency is the nominal interest rate. And this was followed by quite a few people that hinted at the Friedman rule, Harry Johnson and Paul Samuelson, as well as Jim Tobin, all remarking that the real return on currency should be the same as that in other assets for efficiency arguments. That led then Friedman in 1969 to make the observation, the influential observation, that we should think about money, again, not as a liability really, as a good that the government supplies, a public good. Well, then you should just equate the marginal cost of producing it to the marginal social benefit, the Samuelson efficiency rule, and if the cost of producing it is zero, then the social benefit should be driven to zero, that is, the private operating cost should be driven to zero. That implied that the optimum rate of inflation would be minus the real interest rate, and therefore we'd have a steady state deflation. And I will note also that Friedman pretty much disavowed this. As much as the Friedman rule was one of the many reasons why he was famous for, he wrote many times, and certainly very much after 1969, in saying that his preferred target for inflation was zero, in contradiction to the Friedman rule. But the Friedman rule had a life of its own by then, and a gigantic literature developed showing how this argument is pervasive. But if that is the Friedman rule, though, what does it say about the optimum quantity of reserves? I want to go back to the question as posed in terms of the variable that was posed. Is it millions? Is it billions? Is it large? Is it small? Friedman did that thing that economists sometimes do on you, which is you ask them what's the optimum quantity of money and say, well, the interest rate is this. Well, but that's not what I asked. I asked the quantity, not the interest rate. What does the Friedman approach tell you? Well, if we think that there is the real quantity of money has a demand function f of the nominal interest rate, and if you know that the optimal nominal interest rate is zero, well, then the optimal quantity of money is evaluated by the demand function at zero. Fine, no problem. Yet, and this comes out immediately as people have implemented the Friedman rule in general equilibrium theories, or in theory since the mid-70s. Surely the demand for money is satiated at some point, not infinity. But even if it's infinity, approximately at some point there's only so much cash I need. Whatever is your model of money, search, matching, cash in advance, whatever it is, okay? But after that point, once the opportunity cost of holding money is zero, I'm indifferent in holding any more money. But that means that any amount of money above that satiation point, let me call it M star, is an optimum quantity. In other words, the optimal quantity in the Friedman rule is actually indeterminate. It's any amount above a certain level. And when you have this as your history, that says that maybe this was optimal, maybe this was optimal, maybe this is optimal. Interest rates were zero throughout this whole period, even as the balance sheet doubled. Maybe they were optimal before COVID, maybe they're still optimal now. They're always optimal. Maybe they're optimal right now, maybe they're not. Oops, yes. Moreover, not only is there an indeterminacy on what's the actual amount, millions, billions, because there's expected deflation, then the nominal amount of currency is going to be, to engineer that deflation, has to be shrinking. Actually, the optimal quantity of currency in the Friedman rule is zero, asymptotically. The real quantity of money is an intermediate amount, anywhere above this M star, and the nominal amount is zero. That is not a very satisfactory answer to the question. How am I going to make progress in this talk? Modern central bank liabilities are not, though, the currency that Friedman was talking about, or thinking about for the most part. Throughout this period, these 20 years that are so important in terms of variation, in terms of level, it was not currency, the yellow thing here for the ECB, that grew. It is not what's shrinking right now. It's not what is big in size. It's not what drives variance. It's actually the most boring part of them all when it comes to that balance sheet. Rather, all the action in size is in the dark blue, which is bank reserves, deposits of banks at the central bank. So when I ask the question, what is the optimal level of the ECB's balance sheet, I want to ask, what's the optimal level of the ECB's bank reserves? And that is the title of this talk. Reserves are not currency. Reserves have grown a lot relative to currency, both in the euro and the US. That's just blue divided by orange, in case this didn't convince you there. And they're different in 6 ways, even though reserves are money. In fact, me, because I live in London where nobody uses cash anymore, I don't even, when you tell me money in the picture, a little while ago, I even got confused. Is it the queen on them? Is it the king on them? I don't even know. I haven't seen a piece of paper like that in months and months and months. Money, for me, is this, is the fact that I have a debit card that's linked to a bank, and then when I make a payment with that debit card, that leads to a transaction whereby that bank charges its account at the central bank and pays your bank that way. So bank reserves are really the money that at least I use. Okay. How are those different from banknotes, from currency? First, they're really costless to distribute. Currency, we can come up with things on how it takes time to print them. You have to put them in vans. You have to distribute without someone stealing them. Not bank reserves. The ECB could go tomorrow and put plus $1 million at Paribas. It's not hard to distribute. You can helicopter drop them across all the banks. You cannot. It's the easiest thing there is. Second, only banks can hold them now. Okay? The ECB cannot give Volcker plus 1,000 in his thing. Only through the banks. Third, they can be remunerated. Unlike currency, I can pay interest on them. And indeed, we are paying quite a bit of interest on them. Fourth, I can force Paribas to hold a certain amount of them. I cannot force you to hold cash. Cash is anonymous, and you can transact it. I can force you and measure how well you do. I can not only because there's only banks, not only can measure how many reserves they have, I can measure exactly how much cash they have, how much reserves they have, how much they pay them. I can also regulate and get a lot more information on who you are and your other features, because I'm also your regulator. And finally, reserves are the way transactions are settled within the banking system. So when I try to use my debit card or anyone else, that transaction has to work through the banking system. And these 6 differences are, if you want to keep it in mind, are going to be 6 things that are going to drive this talk and all of the ways in which I hope I will improve a little bit on Friedman. I'm not going to follow so much Friedman's Optimum Quantity or Money, but Friedman wrote this as influential or more book on a program for monetary stability. And I want to revisit this. And what I'm going to be doing is trying to think, what is the optimal design of a central bank's balance sheet in the sense of the optimal size of its bank reserves? My approach is going to be back to Friedman's. And that is, this is a problem in public economics as much as macroeconomics. It is a problem that as much as I sit before you as a modest monetary economist or macroeconomist answering, but I'm going to draw as much from the work of Vasiliki from 2 hours ago in mechanism design as from Florian tomorrow in terms of finance into public finance. Sorry, Dave, no link to international trade. Okay. The key insight is to follow the Samuelson rule. If C is the marginal cost of reserves and W is the marginal benefit, reserves V star at the optimum quantity, what I want to find, is what equates marginal benefit to marginal cost. Let's do a first take of this in the data. Here is for the US, the private opportunity cost of holding reserves, meaning if social marginal benefits are going to coincide, and if the private marginal cost is the interest rate spread to an alternative, that's the cost for you to hold reserves, you earn some interest in them, you could have earned some higher interest rate if, for instance, you lent to another bank or bought a bond. Let me plot here the federal funds rate. This is what you get if you lend to another bank, minus what the Fed pays you. Lend to another bank, lend to the Fed. That's the private opportunity marginal cost of holding reserves. Well, if I want to have, if this is the private marginal cost, and I cared about the social marginal cost, well, why don't I measure the private benefit, the private marginal benefit, as simply an inverse demand function? If I measure the price, and I can measure the quantity, I can plot quantity versus price and try to see, can I measure at least that W function? It's very clear that this is a convex function. If I plot this with the data from 1990 to 2009, whatever way you draw, it seems pretty convex to me. Perhaps, as with the satiation term arguments for currency, it has a satiation point. Perhaps it's a kink demand function with a kink over there. Let me zoom in on this kink on the yellow bits. Let me zoom in on just the yellow components, the one that look very flat. If you zoom in on them, you see a little bit of a downward slope. A little bit. You have to color them across into periods. If you didn't color them, it's more like a cloud of points, but hey. Anyway, maybe you see a downward sloping line, maybe not, okay? So maybe it's downward points. There's some evidence for it. But either way, when you focus certainly on that vertical axis and realize that we're talking about differences between 10 basis points plus minus 10 basis points, I'm a macroeconomist. 5 basis points don't get me out of bed in the morning. I can raise rates by 25 just like that. So it looks pretty flat. However, substitution, a caveat is that there's substitution between reserves and non-bank deposits, meaning we can either have banks holding reserves or non-banks holding deposits, in this case at the Fed, through the so-called ONRP facility, as well as banks in providing liquidity. There's going to be a demand for it driven by how much consumers you want to hold bank deposits at the bank. And so because thinking again about this as a standard, trying to estimate a demand function for a public good, could be a subway ride, you want to think about the fact that, well, when I try to figure out how much I use the underground in London, there's the fact that I need to take into account the fact that the government also supplies buses, and the government is going to be adjusting the supply of both of those relatives. And second, the substitution that I can either use public transport or private transport. A slightly more accurate look at that data comes from a very, very recent paper by two great economists at the Fed, who have done that by saying, well, let's deal with the fact that there's a perfect substitution between riding the subway or riding the bus, and let's deal with the fact that by measuring the total amount of car rides, say, those should affect, because there's a substitute from the demand side as opposed to the supply side, to what the demand I want to look for is. And so if you do that, you do end up, and they do end up with a much nicer downward sloping inverse demand function. Although as I plotted it here, inverting their argument, and look at, okay, now that if you have a downward sloping demand function, what is the optimal amount of reserves if then from a Friedman rule type argument I choose here is the right amount of the interest rate there is. And what you see hopefully right away is that one, because there's a lot of volatility in deposits, as well as a lot of volatility in these other public goods supplied by the central bank to the non-banks, you end up with massive variation across the optimal amount of reserves. And second, that this is so flat across different periods, so shifts in deposits or on the other alternative lead to massive shifts. And whenever they're not moving around very much, then you end up with a very, very flat demand curve. Meaning there's going to be, for any time you trace a horizontal line there with a little bit of thickness, you're going to end up with a very large band of reserves as being optimal, as being the ones that will be suggested by whatever amount. So you have very large and unstable demand for reserves from that first tick on the data. So simply applying the Friedman argument, not to banknotes, but now to reserves, continues to leave you an unsatisfactory answer. Maybe you say it's not indeterminate because this is downward sloping, but it's still massively large, and on top of it, massively volatile in a way that central banks certainly wouldn't be happy with, and we shouldn't be happy with as well. So I'm going to make progress. So that's first progress. Not great. It's okay. I still have 30 minutes to go, I think. By breaking down the marginal cost a little better. The marginal cost of supplying reserves to the central bank is not really about the fiscal creation. Instead, it has three components. Let me call the first one A for the cost of holding the assets against those reserves. Because central banks, instead of issuing these reserves, they do them for free to the banks. For some reason, they don't like banks, so they don't just helicopter give them to the banks. Instead, they buy something from the banks and therefore hold them. Well, holding those assets, and there's no asset quite like reserves, is going to involve a marginal cost of holding some of those assets. Second, there's going to be a cost of potentially disrupting other policy goals. As Luigi noted in the introduction, it may just be that when you change the quantity of reserves providing this public good, you're affecting inflation. L could be a Lagrange multiplier if you want. I'm abusing here the math, but it would show up like that in a model of affecting instead your ability to hit an inflation target. And R is instead, well, instead of giving it for free, or instead of charging something from it, why not instead charge for the subway? Why not use the modified Samuelson rule? On the benefit per se, we could break it also into the benefits to individual banks, if there's J of them, and to realize that the benefits are not just to the banks, but also to the non-banks, meaning to all of us who, while we do not hold the reserves, and after all, that demand was just a demand by the banks, our ability to engage in transactions is affected by whether the banks have enough reserves or not. If you want, and perhaps abusing my subway analogy, it's not just how many trains should be running in London, it's also, when we think about the marginal cost of providing the trains, it's not just the buying of the trains, it's the fact that you have to maintain them. There's a cost of whether you want to actually use them to fund other revenues of the government, and whether your goal is simply to provide public transport to many, or rather to favorite same neighborhoods rather than others, if you have some policy goals having to do with regional inequality, say, or dispersion. And likewise, the benefits are not the same for Bilal or Jew or Arnaud, and not only their benefits also for those who don't ride the subway, but who substitute in and out of it. For all of them, note that the distribution of reserves is going to matter, and aggregates will be misleading. But let me analyze then these four components in four sections, A, L, R, and the W's. What is the marginal cost for the bank of holding assets against the reserves? So what Friedman noted was, or one of the things where this was very influential, this book, was that he noted that, or he argued very strongly, and eventually this was adopted by pretty much all central banks in the 1970s, was that the way in which central banks should conduct policies is what's known as open market operations. Open market operations, though, have become, as with everything, a little bit mystical in terms of thinking that God gave them to us. God didn't give them to us. Some guy called Friedman wrote about them, and then people started using them and stopped thinking about them. Open market operations are just, and this is a direct quote from the book, they're just debt management operations. They're just exchanging a one-year liability of the Treasury for a liability of the central bank. There's no more and no less than that. They're not printing money in some magical way. They are increasing the supply of money insofar as that is the liability of the central bank by reducing the liability of the government, the state, sorry, the government, the Treasury. But the liabilities of the state haven't changed at all. The key difference is that in a classic open market operation, a reserve, a debt of the central bank, has the incredible feature of being both infinite maturity, you never have to roll it over, and zero duration. Zero duration, why? Because its interest rate is going to be adjusting at its value at any point in time. It's a really quite remarkable security in that sense. That's the feature of money. Unlike a one-year bond sold by the central bank, by the government, which has to be rolled over after a year, it expires, it requires a final payment, and where the interest rate is fixed for that year. Okay? In classic open market operations, therefore, what there is a change in the debt management profile of the public debt. And this has become even clearer as we do quantitative easing and purchase longer-term maturity government bonds, or credit easing, which is nothing but purchasing other non-government assets, as the Bank of Japan has been engaged in. But what that implies is that once you understand that all you're doing is debt management, that's what the central bank does when it buys its assets. The first effect of this is that by expanding reserves, what the central bank did, here in the example of the Fed, when it did QE and COVID, was massively lower the duration of the public debt. Okay? Note, in a debt crisis, classic debt crisis, what we do by monetizing the deficit is turn a fixed maturity government bond into an infinite maturity reserve. So we stop having rollover crisis. I have a debt and it has to come due every month. I exchange it for a debt that never comes due. Okay? That's not what we did here. That's what you do, I don't know, I won't mention countries in the 1980s would do. What we did here instead was, or although ultimately with the same effect, is lower the duration of the debt. The relevant thing is that we had a debt that had a fixed interest rate. Imagine a 10-year bond that has a fixed interest rate over those 10 years, for instead of debt of the central bank that fluctuates in its interest rate depending on how the payment of interest on reserves fluctuates in some ways. What that meant is that essentially we shortened the duration of the debt, and in fact so much so that when you look at what the Treasury did in response, was they immediately responded by issuing more and more long-term debt in order to actually increase the duration of the debt in response to that. Okay? As a general speaking, as soon as the central bank does QE, the Treasury undoes its effect over the next few months or years. Still, as a comparative static, what expanding the amount of reserves does is lower the duration of the debt. A second effect of it is that when you lower the duration of, when the central bank borrows, as opposed to the Treasury borrowing, when there's losses on that borrowing, who bears the losses changes. It's still the state, for the central bank is nothing but an agency of the government, or the state, I'm sorry, but it changes who suffers those losses. When all interest rates rise, and you had gone from borrowing at a fixed rate to borrowing at a variable rate, that's what you've done by expanding the amount of reserves and buying fixed rate government bonds in it. What you've now done is that when interest rates go up, and on top of it, given the duration from the previous argument, when yield curves steepen, what you've done is that you have now suffered losses for having borrowed at a variable rate as opposed to a fixed rate. Much like all of you had a mortgage and decided to do an adjustable rate mortgage as opposed to a fixed rate mortgage, you lost in the last 2 years. Well, so did the central bank over the last 2 or 3 years for precisely the same reason. Oops, oh, that now got cut. Those losses are larger the size as the balance sheet is larger. Here are some simulations from a paper a few years ago that did the simulations. From a central bank's balance sheet here for the Fed, it goes from 100 billion to instead $1 trillion. The frequency with which it's going to suffer losses, both in terms of the standard deviation of those remittances, as well as, my red things got moved, sorry, when it printed. But you go from never making losses central bank to starting to make losses, from making losses 4% of the time, starting to make losses 30% of the years. Okay? Your estimates instead for how much the ECB is going to end up losing. Okay? The way this happens is that as a central bank, you're now holding a 5-year government bond that you bought that was paying 0 interest, or say 2% interest, and now you're paying 4% interest on your reserves. So every year you're bleeding money, you're recording a loss from now until the maturity of those assets come. Third effect is that even as you borrow using the central bank as opposed to the Treasury, not only it's one special branch of the government borrowing, it's also one special branch group in society, in the public, that is now lending to the government. And that is the banks. For they're the only ones that can deposit at the central bank, the only ones that can lend to the central bank via reserves. Now, you may think that as the banks lend more to the government via their reserves, they will lend less in terms of purchase of Treasury-issued government bonds, so that in fact this is all neutral. But in fact, in reality, that is not what happens. Actually, as you look at the cross-section of banks, those who lend more to the central bank in reserves are also those that choose to lend more to the Treasury in terms of government bonds. So that when you increase the amount of reserves, when you expand the size of the balance sheet by the central bank, what you end up with is a banking sector that's much more exposed to the consolidated sovereign risk of both the Treasury and the central bank. You end up ultimately, or to make it sharper than what it is in reality, when the central bank goes out and buys bonds with reserves, it buys bonds from the public. Public who gets paid how? By deposits at banks, which are then deposited at the central bank. So you return from you, the public, owing me, the government, or sorry, me, the government, owing you, the public, directly, to now you lending to me indirectly via the banks. You intermediate, and all of a sudden, we need to have a bank for you to lend to me, the government. What's the impact of those three effects? First, classic result, with a shorter duration of government debt, a sudden hike in interest rates has a faster impact on the deficit. Give it a year and a half, all we're going to hear about is austerity in public economics, because the line that says interest payments on the debt is growing up a lot. Second, the sudden burst of inflation of the last 2 years actually inflated some of the debt away, but inflated much too little of it away. We could have inflated almost all of it away. We had an inflation, as Tom Sargent has emphasized several times in the last few years, we had a burst of inflation the last 2 years that's very much akin to the one that we always have at the end of wars, and usually inflates away the spending of a war. This time, though, we inflated a lot less of it away because we had a very short maturity. Why? Because the central bank had expanded its balance sheet in the previous 10 years. So we actually only inflated about half it away, so we're going to have to pay taxes for COVID. We didn't pay that many taxes for World War II. We're going to have to pay taxes for the COVID spending. We didn't inflate as much of it away. Second, with the central bank being the state agency bearing the losses, what that means is that you're going to have, as is happening in the UK right now, the central bank being the one that suffered losses with the high interest rates. It attenuates some of the loss the Treasury are going to start suffering in a year or a year and a half from now. But what that means is that it puts a strain in that the Treasury right now has to be recapitalized in the Bank of England. We had the Bank of England lose the money on interest payments. Interest rates went up, and the Treasury here in the UK, the budget for this year barely had a discussion of that, or even of last year. Why? All the losses happened at the Bank of England. The loss of the Treasury are going to happen in a year and a half or two. Well, but that means that now we put an enormous amount of strain on the independence of the Bank of England, because it's easy to say those are the guys who lost the money, and there's a lot of theory on what that implies. And finally, thirdly, on the banks holding more of the sovereign risk, being intermediaries, what that means is that you are going to redistribute the possibility of default risk from banks to non-banks in a way that, especially in the European context, enhances the well-known sovereign bank connection or loop. To conclude on this marginal cost component, one, it is positive. It is not zero, unlike in the Friedman argument. That alone breaks the indeterminacy. It is positive, and I would say increasing. Why? Because you're not in a vacuum disturbance as a helicopter. You're increasing all three of these, and therefore you have an upward sloping C line, C function. Yes, so positive and increasing. Third, it can be neutralized by fiscal policy. In other words, the way the fiscal authority responds in terms of the fiscal backing it gives to the central bank, in terms of the way it manages the maturity, can shift the C function in a very significant way. And more generally, it affects the fiscal monetary coordination. Lessons then for the optimum quantity of reserves. There's no indeterminacy. There is an optimum quantity of reserves. As long as you realize that there's a cost, an increasing cost, there is now a well-defined number. If there is a kink demand curve, this says you should stay at the kink of the demand, or maybe a little to the right because of uncertainty. But forget about whether it's kinked or convex. We'll never be able to test that anyway. More importantly is having started with the fact that the aggregate demand for reserves is so flat, as I think I showed you earlier, you realize that even though most of the research effort over the last few months at ECB and elsewhere has been on measuring the slope of that demand function, well, that is so flat that having argued that the marginal cost function is upward sloping, measuring the slope of that marginal cost function should be much more of a research priority, these three effects as I told you. Because if we pin that down for a very flat demand, it's going to be the slope of the supply that's going to pin down what the optimal V star is. And yet, on these three effects, I just told you, we have very, very little research so far. Second, what about the other goal? Here, let me do just a little bit of theory, not a lot, just a fixed notation. Think about a bank that's trying to choose how much to invest in assets X that give you some return, an unknown return, or deposit in the central bank, some amount V. This bank collects deposits and has some capital to make these investments, its own capital. The bank is going to take into account that there's some liquidity costs. What do I mean by that? Well, I'm going to expand a lot later in the lecture, which is that as I have more reserves, I have more liquidity, I have more liquid balances as opposed to semi-liquidity that gets associated with every other asset involving loans. The more my deposits, the more I promise to provide liquidity, and so I have a higher liquidity cost. But the more my reserves at the central bank, the more I can answer to those liquidity demands, so it lowers my liquidity cost. So it increases in that and falls in that one, okay? Okay? It's just, I think, a very generalish model of a bank. You may have tons of other terms. There's the stochastic discount factor, and there's an inflation because you care about real returns when you form expectations. These are the terms that depend on reserves, what I care about. So if you want plus ... plus ... for all other things that involve banking and have nothing to do with reserves. What is the immediate classic optimality conditions out of that? That you're going to equate the return on reserves, the financial return, as well as what the literature is now called the convenience yield, the benefits of reserves in terms of the liquidity they provide, to the expected discounted return on investments or assets. And likewise, that the return paid on deposits is going to be below the return paid on reserves. Why? Because this bank has an expected liquidity cost of providing that liquidity to the depositors. Note that if you had imperfect competition in banking, you wouldn't have, and like here, this bank would be taking into account a downward sloping demand for these deposits, but still there would be a pass-through, which is what I really want to talk about, from the interest on reserves to the interest on deposits and the interest on the loans. Namely, what I want to talk about, what I want to focus on, which is I think the important thing, is that firms in this economy are going to go to banks and make decisions based on marginal products of capital to equate some risk adjustment marginal product of capital to the rate at which the banks charge it alone. And likewise, households are going to have marginal rate of substitution across time, and they're going to equate those marginal rate of substitution to the deposit rate they're at the bank. All of DSGE, non-DSGE, inflation, output, many things that I've spent maybe too much of my time on, are all about how MRSs and MPKs, that's your model of the economy. How it turns out the marginal rate of substitution, marginal products of capital vary in some way, and they come with trade-offs for output, inflation, and consumption. But as we're looking at the size of the balance sheet, I really want to focus not on those, but on the IDs instead. Namely, if a central bank has an inflation target, which may be stochastic because it varies with output. I don't mean your inflation target 2%. I mean, Bank of England right now, 2.5 isn't so bad because otherwise we'd have a massive recession or something. Then, if achieving that inflation policy goal, some desired pi star, well, it must be that for an outcome of pi star and output and whatnot, the central bank is basically trying to target a particular lending rate by the banks. And how can the central bank achieve that lending rate by the banks together with its pi star? It can do so by either varying the quantity of reserves or the interest on reserves. That is, by either varying the quantity of reserves and the expected liquidity benefits, or the interest you pay on reserves, you're affecting at the margin the interest rate the banks want to charge, and in doing so you transmit to all investment decisions in the economy, as well as savings decisions. But then, if you tie your hands by not paying interest on reserves, what we did with banknotes, what you end up with is the Friedman conundrum, which is because you've tied your hand and you said IV is 0, you now have to choose a value of V, the quantity of reserves, to hit a particular inflation, and therefore the optimal V is either the one that, if the optimal V is the Friedman one, that implied a deflation, which entered in contrast or in conflict with the desired inflation target of 0 or 2% or whatnot. This is the conundrum that Friedman faced, and his biographer Ed Nelson expressed, that the Friedman rule told him I want deflation, but then all of his other policy goals having to do with macro stability said that he wanted 0 inflation. That's the formal argument. That's the formal argument. There's a simple answer to this conundrum, which is the payment of interest on reserves, as hopefully my very general statement made clear. You can optimize over V while allowing IV, the interest on reserves, to achieve the inflation target that you would like to achieve. Paying interest on reserves means that no matter what the quantity of reserves is, you can always adjust the interest on reserves to achieve your inflation target via the transmission in borrowing and lending rates to the real economy and the marginal products of capital and the marginal rate of substitution. This is sometimes misinterpreted. And because I wrote about this 10 years ago, I really want to set the record straight. This does not say that you need to have a large balance sheet. No. It is always the case that paying interest on reserves separates your monetary policy inflation targeting by adjusting interest on reserves from the quantity, the size of the balance sheet. What paying interest on reserves does is that it allows you to choose these completely autonomously. Okay? Is this true? Well, yes. We could speculate about this in 2014-15, but now we've had a big interest rate hike, in bold, the rates of the central banks, and here's what happens to all kinds of private market rates in the economy. We can make a big deal out of the fact that one was up by 20 and one goes down by 6, and the other one goes up by 30. But the fundamental lesson, one that perhaps needs to be rediscovered, is that by changing the on reserves, the central bank, no matter what's going on with the quantity of reserves, can pass through to all the relevant interest rates in the economy, and in doing so, therefore, affect the level of inflation. Okay? Therefore, when we think about this marginal revenue component, the one that really sent Friedman the wrong way and led him to renege the Friedman rule, the answer turns out to be both simple as well as very deep, so deep that it flipped, okay? Which is that it is crucial to pay interest on reserves. As long as you pay interest on reserves, you can use the interest payment on reserves to achieve the inflation target, and if you do so, there will be no conflict whatsoever with the level of reserves. The entire Friedman rule argument on deflation, money going to zero, is eliminated. It stops being irrelevant, actually. Okay. You should end up abandoning the old Friedman rule, just like Friedman himself abandoned it entirely in this book. So, pay interest on reserves and get back to business. You should not be having your inflation rate affect how you think about that. Third perhaps, this was very monetary theory. Let's go more into mechanism design, a little bit along the lines of what Vasiliki was just telling us about. Let me start with two misleading statements. The central bank, you hear this a lot in newspapers every day in Europe. The ECB is subsidizing the banks by paying interest on reserves. We're sending big checks to all these banks. That's evil. No. Banks held government bonds. They paid them an interest rate. The central bank came in and said, I want to buy this bond from you. Here's another piece of paper. Here's another debt, a debt from me, that pays the same interest rate. That's neutral. That's not a subsidy. The central bank is paying interest on reserves the same way the government, the treasury, was paying interest on government bonds. You're not subsidizing anyone. You replaced one by the other. Again, reserves are debt management. Second, the central bank provides valuable liquidity with reserves. It should charge for it. Very appealing argument. I heard it from a very prominent central bank just 2 weeks ago in a speech, or a month ago in a speech, okay? No, that's what Samuelson taught us. Just because the subway is very valuable, that does not say that the optimal price of a ride on the subway should be its value to me. It's okay to give me surplus. I'm a consumer. There's nothing wrong with me getting surplus, okay? Especially if you're the government. Okay? That was Friedman's original enduring insight. Instead, the strong argument is one that dates back to Phelps, who in many ways rediscovered Ramsey. And that is to say that, look, if I charge for reserves, it's akin to collecting a tax on reserves. And once you understand that when you charge for something as a government, when the government is charging me a certain amount, what it is out, £2 for it, £8.10 a day I pay to ride the subway in London, that's just a tax. It's not a price for it, it's just a tax. It decided it could charge me zero for that. Why does it charge me some amount? Because it says, look, I need to tax your subway riding the same way I tax your income, Ricardo. This is how much I trade off in a world where I have distortionary taxation to do it. Okay? A long literature has studied this for currency, which for the sake of time I won't survey. But let me simply think about it in a more classic way. Central bank is a monopolist provider of these liquidity services. Okay? You might say, look, since I've already characterized the demand function, the W function on aggregate, I can calculate with it some attempts at some marginal revenue function and so on, and I will end up with the supplier, even if the marginal cost is the one that we said earlier, the somewhat increasing function, I'll end up with a very small amount of reserves likely, because as you saw, that demand function is very steep when reserves are rare, and then gets very flat. It's a very convex demand function. So the standard answer from a monopolist would be to have very few reserves, maybe like we had before 2008. And now that's what the monopolists do. That's what the government only cared about, maximizing revenue. The Ramsey rule says trade that off with the Friedman argument that you should have quite a lot more. Well, you're going to end up with probably a small amount that just gets very close, though, to, or a small amount that goes a little bit to the right, so not a lot more. But the central bank can do a lot better than this. The central bank doesn't have to be doing Phelps' 1972 monopoly arguments, even though this is the argument that still gets repeated. Why? There's a lot of heterogeneity in the demand for the marginal value reserves. Even as banks hold now many more reserves than they did pre-QE, there was a big distribution before, there was a big distribution afterwards. And the central bank is a very powerful monopolist because it regulates the buyers of its goods. TfL, Transfer for London, does not observe me, does not regulate me as I choose how much to ride its subways. But then you have a much better answer. Why doesn't the central bank do first-degree price discrimination? Meaning, use the interest on reserves to control inflation and charge me, as in a two-part tariff, to extract all of the surplus that I have from holding reserves. Unlike the monopolist who distorts the optimal quantity sold. If that sounds crazy, think about how central banks charged for the reserves. They would have, especially pre-QE, they would have required reserves and would pay zero interest on them. It's exactly a two-part tariff. You charge, you say, here's an amount of required, I observe you, I say your required reserves are $1 million. I say, I'll pay you interest, any amount above $1 million. I know that you're going to end up demanding very close to $1 million. I essentially extract all the surplus while keeping you at the margin. That is, if you look at what the Prague Central Bank evolved, it is great conquest for economic theory. It actually resembles a lot of what economic theory would say. Problem with that, though, is there's really a lot of heterogeneity, not just here, but as you regress this in all kinds of bank characteristics, you get distribution of fixed effects, but not a massive R squared. That is, you understand that the demand for reserves of the banks, as much as the central bank regulates them, there's a lot of unobserved characteristics of banks. And then you end up with realizing, hold on, this is not really first-degree price discrimination. This is much closer instead to the classic Lafont mechanism design problem for the central bank as a monopolist. And again, under the lights of modern mechanism design theory, you look back at old classic discussions in monetary economics, like this very famous essay by George Tolley, and realize that Lafont makes sense of what practical men were writing about earlier. What are the lessons from that literature? And by the way, the distribution is also very large across EU countries, with some countries holding almost no reserves and some very large reserves. Is that first, only the bank that puts the highest value of reserves holds the efficient level. Everyone would hold too few reserves. Only the top bank would get the undistorted interest rate on reserves. The higher the type, the higher the surplus. No distortion at the top, constraining a supply. That surplus varies with type. The three classic answers to the Lafont problem, if you want. And so, as a result, if the central bank is going to adopt this, I'll take 5. What we learn is that from the marginal revenue component, it would be positive, but it would involve very large rents across the euro area financial systems. Namely, it would involve, at the top, remunerating, let's give them names, the German banks, and extracting a lot of surplus from the Italian and Spanish banks. All in order to be able to tax them and collect revenue. It is unclear that we'd like to be doing this in such a large extent. But as today, it is a very active decision, suppose the ECB is going to decide this in January or February, whether to increase the required reserve requirement on all banks, it is important to understand that what you're doing is behaving like a monopolist. What you are doing is taxing the Italian and Spanish banks in a very large way, involving therefore a very large amount of redistribution. And what you're doing is massively distorting your transmission of monetary policy in doing that. And so maybe that's not such a great idea. Have required lower minimum reserves, but you should set their level low. And as the ECB doubled its level of not paying interest on reserves just 6 months ago, and it's considering increasing it massively in order to collect more revenue, solve its political problem of having lost money in the last year, understand that the ECB may be about to make a gigantic mistake, in my modest opinion, by increasing required reserves, behaving just like a monopolist, forgetting that you're a public good supplier in order to cover a hole in your balance sheet. Finally, on the distribution of benefits, if the secondary market for reserves is efficient, they'd all be the same. But it is not efficient. And I'm going to talk to you about 4 sources of inefficiency in my 4 minutes, because I didn't manage my time well. Okay? First, banks, after they hold their reserves, they have to, during the day, match with each other in interbank markets, use over-the-counter markets to deal with the fact that they have withdrawals of liquidity and or calling on credit lines. They bargain, and there's a cost to being in the interbank market. There's a cost of having a money market trader. That cost is real. There's many banks that never borrow or lend to other banks. They just show up at the discount window, even though it's very expensive to do so. Because it's better to do that than to have 3 guys that you paid a lot of money to borrow and lend to other banks. About a quarter of all banks in your area, small banks, only borrow from the discount window. They don't borrow from interbank markets. Therefore, there's a cost, one that's often ignored. If there's a cost of opening that, and again, even as we increase the amount of reserves, we see that it's less often that banks go in overdraft, which is a direct measure of that cost. What that means is that there's going to be, if there's a cost of making this interbank market function, there's going to be a Hosius type condition. And there's going to be an optimum quantity of reserves that takes into account that cost. When we have a very large balance sheet, what we're doing is we're going to the right of the Hosius condition. What we're doing is we're destroying the interbank market. What we're doing is saying that all banks stop investing in having a money market trader, stop investing in rearranging liquidity between them. Problem with that is, as reserves grow, you might say, well, but as reserves grow, sure, there's no interbank market, but then again, there's no need because we all have lots of reserves. No. As reserves grow, many banks continue to have very few reserves. And we can see that also because many banks end up having overdrafts and paying quite a bit of expensive costs on it. Second, having assigned reserves, think about this as really a mechanism design problem with 2 stages. In the first stage, the central bank assigns reserves. But in the second stage, the banks are meeting and bargaining, as I said. We talked about whether the market can be too tight or too loose. And arguably, it was too loose over the last 10 years. But as in fairly recent work in mechanism design, we can think about this as both a problem of assigning the public good as well as the information we reveal when we assign the public good. Namely, because the central bank can reveal information on what are the required reserves, and especially what are the terms to obtain reserves by the banks. The central bank can give you more reserves if you show up at your discount window. But what information should the central bank release? In principle, the information releases affects then the way the other banks want to deal with it. And here, in a recent econometric paper by Dvorak, there's a very strong and important result in information which is that if you design a discount window and you know banks are going to trade afterwards, you should not reveal any information, meaning you should have simply a cutoff rule that says that a bank is eligible or not to be in a discount window. Why? That is the only way to avoid the stigma of borrowing from a discount window, of borrowing from the central bank. That is the only way to foster truthfulness. This is especially relevant for the ECB as we have Southern European banks showing up to borrow and German banks or core banks showing up to lend, as taking these differential reserves into account by the ECB and treating them differently would, in principle, create a run at the central bank. Banks and non-banks.
We exhausted the reserves.
Okay, sorry. One more. Yes, okay. Let me just tell one thing. On top of it, the other problem is that there's an adverse selection problem that appears. Oh, let me just talk about this. What happens, though, when because of an adverse selection problem, sometimes non-banks run on banks? Well, the central bank could increase the amount of reserves, but instead, by having a lending facility such that it allows banks to go and, in those stages, have the central bank automatically, elastically supply the extra liquidity, it can alleviate the adverse selection, the problem. So, have a discount window, have a lending facility, have the quantity of reserves function. Let me conclude. What is the optimum quantity of bank reserves? What I think I learned from using modern economic theory, mechanism design, and I think public economics, both looking at the slopes of demand functions as well as the theory of Samuelsonian type supply, was that first, you really have to look at the other policies in place. The maturity of the assets in the central bank's balance sheet, how it pays interest on reserves, to what extent it uses required reserves, whether it has a well-designed discounted lending facilities. Depending on the answer to these, you can have a size of reserves that's 10 times bigger, or I just made that up, much bigger or much less big. And so you really cannot answer that question without answering these ones. And in fact, that if the central bank, if the ECB were to move towards what MEX's design and others have said you should design optimally the way you're doing purchases and facilities, the ECB's balance sheet could be much smaller than what it is now. It is large now because of all of these other bad design features. And the size in the end does not have to be very large. It can shrink quite significantly as long as we design the other ones better. Sorry for the bad management, but yeah. Thank you.
Okay, so maybe we have time for a couple of questions. There's a question here on the second row.
Thank you, Ricardo, for your really interesting keynote talk. So I'm trying to think of the mapping between the several interest rates that you mentioned to the Taylor rule we typically use in macro models. So now you've got the interest rate on reserves. On the other hand, you've also got the policy rate, that the interest rate that central bank can receive. Should we think of the spread between these two interest rates as something that the Taylor rule should target? So for example, ECB has the deposit facility rate and also the main financing operation rate. Should the spread between these two interest rates be mapped into the Taylor rule?
Very quick answer, no. Meaning, that goes back to the principle that the interest on reserves is the one to which the Taylor rule applies. That's the one that targets inflation. And then those are all the other interest rates should move proportionally together. That was one of the things many things I didn't have time to. I'll write a book on it. That was one of the many things. They all have to move together because those spreads, all they are controlling is precisely either the mechanism design side of the allocation between banks and non-banks, or the amount that you're extracting as a tax. That's what those are about. Those are not about monetary policy, Taylor rule. That's the autonomy principle that I was saying. The Taylor rule should be only about the certain reserves. All those spreads are about the other determinants, including the quantity of reserves.
Any more questions?
I've gone over time, so I'll stay here for people who have questions. Sorry for taking too long.
All right. Thank you. Thanks, Ricardo.